Okay, so for today, we are going to discuss accounting for merchandising business. Okay, so a merchandising business is involved in buying and selling goods without any alteration made on their state or condition. So, meaning once you buy the goods, you can immediately take it home, and then sell it as it is. Okay, so there is very little to no conversion at all. Okay, so this is the normal operating cycle of a merchandiser. So of course, we start with cash, and then we purchase goods on account. Therefore we record a payable, and then of course we also have our inventory. Then once we sell the inventory on account, we will have receivables, and then later on we'll collect our receivable, and it will become cash again. So as compared to the normal operating cycle of a service business, the normal operating cycle for a merchandiser is relatively longer, because for a service business, most of the time we do not there is or for a service business, our customers pay us immediately for the services provided. But for a merchandiser, most of the time we sell the goods on account, and we also purchase goods on account as well. So one of basically accounting for merchandising business, whatever you have learned during in accounting for a service concern, is also applicable in accounting for a merchandising business. However, there is a difference on how we measure our profit. Okay, because in service business, in a service concern, what we do is we have our service revenue account. That is our revenue account, and then we just deduct all our expenses. But as far as a merchandising business is concerned, this is how we measure profit. So we always start with our sales. Okay, this is the main revenue account for a merchandiser, and then we have the sales returns and allowances and sales discounts. We deduct this from our sales to be able to arrive at the net sales. So the sales returns and allowances and the sales discount accounts are both contra sales accounts. Okay, now we also deduct from the net sales. We will deduct the cost of sales to be able to arrive at the gross profit. Once you have arrived at the gross profit, that's the time that you deduct all your operating expenses, interest expense, and income tax expense before we arrive at the net income. So later on, we'll discuss how to compute for the cost of sales. Okay? So a merchandiser can use two inventory systems, diba? We have the periodic inventory system and the perpetual inventory system. So during the first part of our discussion, we will discuss periodic inventory system first, and then later on we will discuss the perpetual inventory system. So, under the periodic inventory system, the cost of sales or the cost of goods sold is determined at the end of the period through a physical inventory count. So, you will know if the merchandiser is using the periodic inventory system once you look at their chart of accounts or their books, and you find the following account titles. So, they are using the purchases, purchase returns and allowances, purchase discounts, and freight in accounts. So if you find these accounts in the trial balance or in the books of the business, it means that the company is using the periodic inventory system. So because of most of the time, diba? Most of the time, companies using the periodic inventory system are companies who sell large volume of products, who have very large volume of inventories with a relatively low sales value. Okay, so what happens here is that later on I will show you the proforma journal entries, but just the same, because we do not update our records real time as far as selling of the goods is concerned. our cost of sales is only determined at the end of the period through a physical inventory count. So these are the pro forma journal entries under the periodic inventory system. So whenever goods are purchased, our entry is to debit purchases and to credit cash or accounts payable. Okay? Whenever goods purchased are returned, we debit cash or accounts payable and credit purchase returns and allowances. So later on, we will differentiate between purchase returns and purchase allowance. And then, if the account is paid within the discount period, our entry is to debit accounts payable, credit purchase discount, and credit cash. So, the purchase returns and allowances and the purchase discount accounts are both contra purchases accounts. So, both accounts have normal credit balance, whereas the purchases account has a normal debit balance. Okay. Now, to continue the pro forma journal entries for under the periodic inventory system, whenever goods are sold, we prepare the entry to debit cash or accounts receivable if we sell goods on account, and then we credit sales. If goods sold are returned, our entry is to debit sales returns and allowances and to credit cash or accounts receivable. If account is collected within the discount period, we will debit cash, debit sales discount, and credit accounts receivable. So both this set of entries, the one in the previous slide and this one, are found in the books of a merchandiser because based on the nature of operations of the company or of the business, diba? They are the merchandiser is involved in buying, so these are the entries whenever we buy goods, and selling of goods. So these are the entries naman whenever we sell merchandise. So both these entries are found in the books. Okay? So before we continue, let us discuss discounts. So discounts, of course, are reduction in the selling price. So there are two types of discounts. We have the trade discounts and the cash discount. So what is the difference between the two? So trade discounts is given to our customers or is given to us if we are the customer because of the long-term relationship of the buyer and the seller. So usually it is also given for the whenever you purchase in bulk. So if you purchase if you purchase in large volumes or large quantities, you will be given, it is possible that you will be given a trade discount. It is very important to remember that trade discounts is not recorded in the books. So whenever you go to the store and then you ask the seller how much is the selling price, and then they tell you that the selling price, for example, is 100,000. So that is the list price. So if you ask for a trade discount, let's say the seller allows you to have a trade discount of 10% and then another 20%, diba? You have to deduct the trade discount before the trade discount of 10% and 20% respectively to be able to arrive at the invoice price. So since we do not record the trade discount in the books, the invoice price is the one we record as our purchases or our sales. Okay? So another thing that you need to remember about trade discounts is that if you are given multiple trade discounts, just like our example earlier when as I was saying, the seller gave you a 10% and then a 20% discount, you cannot add the two. 10 plus 20 equals 30% and then deduct the same from the list price. You cannot do that, no? So you in our example, 100,000 times 30%, that is 30,000. So the invoice price will be 70,000 only. No, that is wrong. Whenever you are given a series of trade discounts, you have to apply the first discount, the first discount given first, and then using the net amount after the first discount, you have to apply the second one. So in our example earlier, the list price is 100,000. and then you are given a 10% trade discount. So minus 10% of 100,000, we have that is 90,000, and then you are given another 20% trade discount. So 90,000 times 20%, that is equal to 18,000. 90,000 minus 18,000, the invoice price will be 72,000. So it is smaller, or the discount is smaller whenever you apply it one by one, rather than computing for the sum of the discounts and then applying it all at once. Okay, so again, trade discounts is not recorded in the books, and if you are given a series or multiple trade discounts, you have to apply the discount one by one. Okay? Now, for the cash discounts, diba? We give cash discounts to encourage prompt payment of amount due. So whenever we sell something on account, or whenever we purchase something on account, usually we have what we call the credit terms. So what are the credit terms? So we have, of course, you have to give your customer a deadline. When are they required to make the payment, and then usually the credit terms is around 30 days, 60 days, no? So you will see in some problems or in the invoices, it is indicated N over 30, N over 60. So it means that the full amount is due within 30 days or within 60 days. You have to pay within on or before 30 days. Okay? Or you have to pay on or before 60 days. But sometimes you will see something like 2 over 10 and over 30, or 2 over 10, 1 over 15 and over 30. So what does that mean? Okay? So if you see 1 over 10 or n over 30, 1 over 10 or 2 over 10 or 1 over 15, it means that you will be given a 2% discount if you pay within 10 days. Or for 1 over 10, you will be given a 1% discount if you pay within 15 days. And of course, the full amount is due within 30 days. So that's how cash discount is given. That's how cash discount is given. So cash discounts is recorded in the books as purchase discount if we are the buyer, or a sales discount if we are the seller. So to determine the amount of the cash discount, we have to get the invoice price and then multiply. Before that, you have to check first if the payment was made within the discount period. If not, the customer or we as the buyer are not entitled to a cash discount. So once you have determined that we have paid within the discount period, we get the invoice price, and the balance, or rather no, not the invoice price, because sometimes we pay something in cash na eh. So you get the accounts receivable or the accounts payable due to the supplier, and then we multiply it by the percentage of the cash discount offered to us. Okay? So next, we have returns. Okay? So earlier, we have the purchase returns and sales returns. So of course, purchase returns account is used if we are the buyer, and then sales returns account is used if we are the seller. So what is the difference between the two? Because we use a single account title, purchase returns and allowances, and sales returns and allowances. So the main difference between the two is that a return involves a physical return of goods, of course, and then actually both returns and allowances result to a reduction of the accounts receivable or accounts payable. Okay, so before we differentiate the two, let us mention their similarities. So their similarities is that, number one, they are both reduction of the account due to the customer, account due from the customer, and account due to the supplier. So, reduction of accounts receivable or accounts payable. Why? Why do we need to reduce the accounts receivable or accounts payable? Because these returns and allowances arise because the supplier or us, if we are the supplier in the transaction, has delivered defective goods or goods that are not wrong goods. So for example, you have delivered, let's say, the customer has ordered 1,000 small shirts, but you have delivered 1,000 extra small shirts. Okay? So it is up to the customer to decide if they will accept what you have delivered or if they will return the goods to you. Okay? So if they decide to return the goods to you, you have to write off, or you have to reduce your accounts receivable. Okay? But for example, you have delivered 1,000 extra small t-shirts, but the customer decided to accept your delivery. Even if you have delivered the wrong goods. So what they will do is they can call you and they will ask for an allowance, because most of the time the price of a small shirt is greater than the price of an extra small shirt. So they may ask you for a reduction in the selling price or an allowance because you have delivered the wrong goods and they decided to accept it. Okay, another example is that they have ordered, let's say, 100 pieces of t-shirts, and then you have delivered it, but upon inspection, um, there are holes in the shirt. Let's say 10 shirts have holes in it. So, if that is the case, again, it is up to the customer to decide if they will return the goods, if they will send back the goods to you, and then you have to reduce the accounts receivable from the customer. Or the customer may call you, the customer may decide to accept the goods, and then but will ask for an adjustment of their account. So if the customer decides to return the goods to you, that is a purchase return, or sales return. But if the customer decided to accept the goods but ask for a reduction of the amount due to you, that is an allowance. So that is the difference between the two. So again, an allowance is an adjustment in the selling price or purchase price as a result of defective goods or wrong item delivered. So that's the main difference between the two. Okay. Next, we have to talk about the shipping terms. So the shipping terms is very important in determining who owns the goods in transit. So, of course, at the end of the year, this is very crucial, especially later on once you begin to discuss inventory in detail. Okay, so we all know that not all goods ordered or purchased are delivered to us as of the end of the year. So sometimes at the end of the year, at the end of the fiscal year, some of the goods are still in transit. So to determine who owns the goods in transit, it is important to refer to the shipping terms. Okay, so another importance of the shipping terms is that through the shipping terms, we determine who record the transportation cost in the books. Okay? So the shipping terms can either be FOB shipping point or FOB destination. So FOB means free on board. Okay? So basically, these two terms, they indicate where, when and where does the transfer of ownership happens. Okay? So FOB shipping point, if the terms is FOB shipping point, it means that the transfer of ownership happens once the goods are transported, or once the goods leave the premises of the seller. Okay? So once the goods leave the premises or the warehouse of the seller, it means that the ownership of the goods has already transferred from the seller to the buyer. So the goods in transit is already owned by the buyer. Now for FOB destination, the transfer of ownership happens once the goods has reached the once the goods has reached the warehouse of the buyer. So during transit, the goods is owned by the seller. So it also follows that whoever owns the goods, they will be the one to record the shipping cost in their books. Okay? It doesn't always necessarily follow that whoever owns the goods will be the one to pay cash to the courier or to the transportation company. So sometimes, um, what happens is that uh, sometimes the seller pays the freight company in advance, or sometimes the buyer pays the freight company regardless of who owns the goods. So we have the payment of shipping fee. It can either be freight collect or freight prepaid. So when we say freight collect, it means that the buyer pays for the freight cost at regardless of who owns the goods. And then of course for freight prepaid, the seller pays for the freight cost. So there are a couple of there are combinations, and then here, so that it will be much more easier to understand. So the payment of shipping fee in terms of shipment, sorry, in terms of shipping. So we have FOB shipping point, freight collect. The owner of the goods is the buyer, and the one who pays the transportation cost is the buyer. So there is no problem. There is no problem with this, because of course we know that the one who owns the goods rather, should pay for the freight cost. So there is no special adjustment, or there is no adjustment in the payable or the receivable. Now, it is another story if the terms of shipment is FOB shipping point, freight prepaid, because when the owner of the goods is the buyer, but the one who pays the transportation cost is the seller. So therefore, what will happen here is that there will be an additional liability to be recorded by the buyer, because the seller has advanced the freight cost for them. Okay, so there is an adjustment in the payable or the receivable of the buyer to the seller. Okay. Now, we also have FOB destination freight collect. So for FOB destination freight collect, um, the owner of the goods is the seller, but the one who pays the transportation cost is the buyer. Now, because there is a mismatch, whenever there is a mismatch between who the owner is and who pays for the transportation cost, we will have an adjustment in the amount of the payable or the receivable. Okay? Now, lastly, FOB destination freight prepaid, there is no adjustment needed, because the owner of the goods is the seller, and the seller also pays for the transportation cost. So whenever you answer problems, you will encounter problems wherein the only shipping terms indicated is FOB shipping point and FOB destination. So if the problem is silent, it means that um, FOB shipping point freight collect is the shipping terms, and FOB destination freight prepaid is the shipping terms. Okay? So the transportation, so we have the following. Right? So the transportation cost. So of course, if the terms of the shipment is FOB shipping point, meaning the buyer is the owner of goods, and the buyer will be the one to pay and record the transportation cost in their books, we use the account transportation in or freight in. So the transportation in or the freight in account is considered as a purchase related account. It is a purchase related account, and eventually it will form part of the cost of the inventories. Okay? And then, if the shipping terms, if F is FOB destination, the seller is the owner of the goods in transit, and therefore the seller has to pay for the transportation cost. In the books of the seller, they will record transportation out or freight out, which is considered as a selling expense. So again, since we are the since we are if sorry if we since we can be the buyer and the seller at the same time, we can both have the transportation in or freight in and transportation out or freight out in our books at the same time. So to record the freight in, okay, our entry is to debit freight in and to credit cash. This is with assumption that the shipping terms is FOB destination, FOB shipping point rather, freight collect. Right? So we will discuss later on what will be the entry if the shipping terms is FOB shipping point, freight prepaid. Okay? So for the freight out, the entry to record the freight out is to debit freight out and credit cash, assuming the shipping terms FOB destination, freight prepaid. So later on, we'll discuss also what if the shipping terms is FOB destination, freight collect. Okay? So we go back to the previous slide that I have shown earlier. Of course, we have the measurement of profit. So again, we start with sales. We deduct the sales returns and allowances and sales discounts in order to arrive at the net sales. Then, to arrive at the gross profit, we deduct the cost of sales. Let us discuss how to compute for the cost of sales or the cost of goods sold. So, the cost of goods sold is computed as merchandise inventory beginning plus net purchases. So, to compute for the net purchases, we get the amount of our purchases for the period and add the balance of the freight in or the transportation cost, and then deduct all the purchase discounts and all the purchase returns and allowances. That is the net purchases. Okay? So when we add the merchandise inventory beginning and the net purchases, we'll arrive at the cost of goods available for sale. And then deduct the merchandise inventory end. That's the cost of goods sold that we will deduct from the net sales to be able to get the gross profit. Okay, so we'll practice the computation of our cost of goods sold later on. So that's it for the periodic inventory system. Now we move on to the perpetual inventory system. So under the perpetual inventory system, the cost of goods sold is readily available in the books because we do not have to perform a merchandise inventory count to be able to determine the cost of goods sold. The merchandise inventory balance can be determined at any given time. Because upon purchase and sale of goods, we constantly update our records. So usually, the perpetual inventory system is used by companies who have low volume of goods, low volume, high valued merchandise. So examples of which are jewelry stores, etc. So now, it doesn't mean that because the merchandise inventory balance is readily available, we will not conduct the physical count. Remember that we can still conduct the physical count in order to check if the goods or if the merchandise inventory recorded in the books are physically present. Okay? So what are the proforma journal entries for under the perpetual inventory system? So when the goods are purchased, our entry is to debit merchandise inventory instead of the purchases account and to credit cash or accounts payable. And then when the goods are returned, when goods purchased are returned, we will debit cash or accounts payable and credit the merchandise inventory account. So notice that under the perpetual inventory system, we do not utilize the purchases related accounts anymore. So look at the third entry. If the account is paid within the discount period, the proforma journal entry is to debit accounts payable, credit merchandise inventory, and to credit cash. So lastly, the entry to record the payment of the transportation cost is to debit merchandise inventory and to credit cash, assuming the shipping terms is FOB, the shipping point freight collect. So again, we eliminate the purchases related accounts and charge and credit everything to the merchandise inventory account. Now, these are the proforma journal entries. Under the perpetual inventory system. When goods are sold, we debit cash and or accounts receivable and credit sales. Now, there is another required entry. There is another required entry, which is to debit the cost of goods sold account and to credit the merchandise inventory account. So this entry is not present. This is not present in the periodic inventory system. So the reason why we can immediately get the cost of goods sold and the merchandise inventory figure under the perpetual inventory system is because we constantly update our cost of goods sold and merchandise inventory whenever we sell goods. Remember, in periodic, what we do is we utilize the purchases related accounts. We do not debit or we do not do anything with the merchandise inventory account, and we do not record CGS. So that's why at the end of the period, when the boss or when the owner asks you how much is my ending inventory under the periodic inventory system, you cannot answer him or her right away. But under the perpetual inventory system, you can easily answer the owner if he or she asks you when or how much is the ending inventory or the cost of goods sold at any given time. When goods sold are returned, of course, your entry is to debit sales returns and allowances and credit cash or accounts receivable. Another entry is required, which is to debit the merchandise inventory, because since the supplier or since the customer rather has returned the goods to you, diba? You have to update your inventory records and of course reduce the cost of goods sold, because your sales was reduced by the amount of the goods returned. And then lastly, if the account is collected within the discount period, our entry is to debit cash, debit sales discount, and credit accounts receivable. Now, there is no corresponding entry to update our inventory account, because there is no physical flow of goods whenever we give cash discount to our customers. Okay? So now we go back to the periodic inventory system. So our focus really is the periodic inventory system. So the adjusting journal entries for a merchandising business is basically the same as the adjusting journal entries you have learned for a service business, with some additional entries because of the specialized nature of the merchandising business. Remember, we have the merchandise inventories, or we are involved in the buying and selling of goods. So now we have a couple of more adjusting entries. Okay, so what are the usual adjusting entries ba? We have, of course, number 1 is for the accrued income earned but not yet collected, but cash is not yet collected. We also have accrued expense. So these are expenses already incurred but not yet paid. And then we also have prepayments. So for the prepayments, these are expenses that we have already paid for but not yet incurred or used. And then we also have unearned income. So these are income that we have income that we have collected cash from, but we haven't performed the services or we haven't delivered the goods yet. We also have adjustments for depreciation expense as well as adjustments for bad debts expense. So in addition to the 6 adjusting journal entries you have learned in service business, in accounting for a service business, we will add a couple of more, no? So what are the adjusting journal entries for a merchandising concern? So this adjusting journal entries we are assuming that you will use the cost of goods sold method in preparing the worksheet. So later on we'll discuss that also. So the first adjustment is to close the merchandise inventory beginning account. So in preparing the adjusting journal entries for a merchandising business, you have to remember that when you are asked to close something, 'di ba, you always have to, of course, we know that a journal entry has two parts, the debit and the credit. So if you are asked to close the merchandise inventory beginning account, the normal balance of the merchandise inventory beginning is a debit balance. So if you need to close, you need to credit the merchandise inventory beginning account and then debit the cost of goods sold account. So the first entry or the first adjustment is to debit cost of goods sold and credit merchandise inventory beginning. Second adjustment is to close all the purchases related accounts. So what are these purchases related accounts? We have purchases, freight in, purchase returns and allowances, and purchase discounts. So the first two that I mentioned, purchases and freight in, both have normal debit balances. And therefore, to close, our entry is to debit cost of goods sold and credit purchases. To close the freight in, our entry is to debit freight, cost of goods sold rather, and to credit freight in. Now, for the purchase returns and allowances and purchase discounts, they both have a normal credit balance. So, to close the account balances, we debit the purchase returns and allowances account and credit the cost of goods sold account, and then debit purchase discount and credit cost of goods sold as well. After this, all the purchases related accounts are already reduced to zero balance. Third adjustment is to set up the merchandise inventory end account. So we will set up the merchandise inventory end account because as of the end of the year, the amount of the ending inventory is really the asset that we have, really the goods that we can sell in the next accounting period. Okay? So our entry for this is to debit merchandise inventory end and to credit cost of goods sold. Okay? So after preparing these journal entries, you will already have a balance of the cost of goods sold, which you will use. Where is that? This one, which you will use in the computation of the net income, gross profit, and then the net income. Okay? So for the worksheet preparation, this is what I was telling you earlier. We have the cost of goods sold method and the direct extension method, the mechanics of which I will discuss in the next videos or in the coming videos.